How's it going, ladies and gentlemen? We've done a good amount of whiteboarding on this show, and we are about to explain another pretty difficult concept. How are these FTDs cyclical, and what exactly is the ticking time bomb on this explanation of how are they doing it? How are they keeping the price down? How are they continuing to attack it where none of us are deciding to sell and we are all buying and holding? If you guys can follow along and understand this is not financial advice, we have this DD here starting from the too long didn't read. Guys, I want to give you guys the full information first with this too long didn't read and give full attention to the user that wrote this article. All right. So first things first, thank you guys for jumping on in, sticking to the end, clicking that like button so that more Moon Platoon members, more Space Apes can find this video. The algorithm likes it when you press that like button, and of course hopping on and investing in yourself if you would like to press that subscribe button and join on board. I'm going to be popping back out and in. This is a long theory, so bear with us and make sure that if you have any questions, drop them in the comments down below. Too long didn't read. The shorts are in a death spiral of borrowing to cover FTDs and using HFT trading tactics to cover the remaining FTDs that the borrowed shares could not. Whales are on our side, but are putting their effort into controlling buy-sell pressure on certain days to inflict max pain on the shorts option spread. The price action we are seeing is largely made of HFTs, retail, the odd day trader or two. That's looking at you. Scissors in the chat right now for all the paper hands, right? The odd day trader. That's the odd one. And of course, this is not financial advice, yo. One of the things that we'll already be pulling out the board for is what FTDs are, failure to deliver. We've covered these a while ago. Let me scroll all the way to the top and you'll see exactly how much we got to cover here. This is, of course, the key piece of the puzzle by user JSMAR18. All right, so we had all of these diagrams here. Most important thing is that this cloud here, right? This some ethereal realm where we can birth a share can come just because in the American system, after all, in a bunch of European systems, this is not allowed. But we have this plausible, like, probably going to find a person to borrow this share from kind of mentality, right? You can create a counterfeit share right away and short it immediately. This is naked shorting, which causes FTDs, failure to delivers, and this is the reason why we are going to unveil what is happening with this situation. You guys ready? Let's follow closely. Our previous post theories were 1/4 right, but missing something extremely important, that being add liquidity only orders and supplemental liquidity providers SLP, which explains 4 things. 1, why we see huge volume pop on TDTOS for GME. Number 2, why we see huge volume pop on TDTOS for other stocks. Number 3, why we see it as in the volume column with no buy-sell orders lodged against it. Number 4, why this volume can't be used to calculate short interest, potential prices, or whatever other. All right, let's get going here. The middle 2 points being where people still had questions around, and the latter other posters speculating and using them incorrectly. Nothing wrong with this. The sub is about improving our analysis when new information is found. Now this will be a long read, which is why we're trying to be able to get this through with all of you guys. And if you have any questions, drop them in the chat so that we can cover them. All right, the acronym legend, right? First of all, if there's too many acronyms, let us cover them right now. We already talked about a bunch of them so far. NYSE, New York Stock Exchange. The IOC ISO is immediate or cancel intermarket sweep order. ALO is the additional liquidity order. SLP is the supplemental liquidity provider. TDTOS is TD Ameritrade Think or Swim. MM is the market maker. HFT is high frequency trading. FTD is failure to deliver, and MSM is mainstream media. All right, some of these are not that necessary. Like this one is not that necessary to fully understand, right? I guess all of the rest of them are pretty important. TDTOS is just a platform for you to be able to look at data. Let's get into it. The same assumption regarding the NYSE Chicago being a sandpit for Citadel and Co. remains from the same previous post. Let's recap what we saw in terms of order behavior on this exchange over the past 6 months. We saw volume shift away from limit non-routable IOC to 1 IOC ISO. We have limit non-displayed, and then we have add liquidity only ALO, right? This is getting a little complicated, but look at September 20th to February 21st, right? We had IOC ISO become one from 20%, right, low, all the way to 40.95% and staying at that 40% range, where limit non-routable IOC is dropped from 54% all the way down. Essentially, just take note that one of these one of these places of volume here is being shifted into the other three that we see in this table. So these three types of orders are the keys to the puzzle we've been needing to figure out their strategy to manipulate GME prices. Let's start off by getting an understanding of what they are. Bear with the explanations, pretty graphs, charts, and some pretty mind-boggling conclusions lay beyond the order type explanations. So IOC, ISO, immediate or cancel intermarket sweep order. For those who have not read the previous post, here's an excerpt. A intermarket sweep order is a large quantity order that is sent to multiple exchanges. This is how it functions. Number one, an order is submitted to the pre-market to sell the price at 40.80 and is sent to exchange A. The best offer price on exchange A is 40.63, right? And then exchange B receives an intermarket sweep order to buy 800 shares of the stock at a limit price of 40.88. The best offer price on exchange B is 40.88. The trader that enters the intermarket sweep order would be required to fulfill the regulation NMS requirement by executing the maximum available quantity on exchange A at 40.63 and then may execute the balance of the order on exchange B at 40.88 even though it is at a price that is inferior to 40.80. Order resting on the book of exchange A. The 40.80 price is not inside the quote and therefore not protected in terms of the balance of the sweep order executing at exchange B at a price of 40.88. So that was a lot. Let's focus up on this board here. Just know that there is some slack and there is some, let me give this a quick sweep here. Essentially, what is happening here is that they want to sell at a specific price, right? 40.80 or higher. This is sent to exchange A. This is an order that can be sent to multiple exchanges, and currently the price is you wanted to sell it at 40.80. You'll be happier to sell it at even a higher value. However, on exchange A, we only have 40.63. That is lower, so they're not going to be able to execute this order as of right now. However, on exchange B, there is a best price of 40.88. That's higher, right? So composite, these two together, this is A, and then this is B. Composite, these two actually could even out to be able to execute all of these orders on 40.80 on average. So once more, we're focusing up on the idea that 40.63 is inferior, right? It is not as good. It is not inside the quote and therefore not protected in terms of the balance of the sweep order. However, they can execute it as a sweep order together because composite, they work together here. And I know that text was inverted, apologies, but we have the general idea here. In monkey speak, it fills the lowest alternate exchange price before filling the order at the higher price. So to make it more complicated, this is an order with a modifier. So let's understand an IOC. These are orders which attempt to execute immediately and cancel any unfilled portion. For example, place a buy order for $10 at 1.80 and 1 cent, only to be filled to a portion of 5 at 1.80 to 1 cent and then canceled right away. A key part to these type of orders is derived from the following. Right, the intermarket sweep is exception enables trading centers that receive sweep orders to execute those orders immediately without waiting for better priced quotations in other markets to be updated. Right, almost like it will be handy for NFTs. Wink, wink, nudge, nudge. Here we go. Limit non-displayed. Okay, we're gonna drive through these two so that you guys at the very least understand a general concept for these two concepts as well. This means, so in order to buy or sell a stock at or better than a specified price, these orders are hidden from us, apes, and others. They also don't care about lock or cross situation cases. For instance, the previous post for understanding on this. Mainly, the most important part is that this is that HFT can effectively jump the line by posting a hide not slide order. This is because a hidden order will not be slidden, resetting the timestamp. Getting a little complicated, but this is a way that by not displaying this order, an HFT algorithm could essentially say my order is more important than everyone else's, slide it right underneath to get executed immediately. Finally, ALO, right? Monkey speak translator, these orders create sell buy walls that have nifty function that essentially flips the safety switch back to the original limit order price if too much buy sell pressure is applied. The last thing we need to talk about are the SLPs. This is not an order type, but it'll clear up many questions. Then we'll get to analyzing price action after this one, the fun part. So if you guys still don't understand fully what ALOs are, which are add liquidity only, limit non-displays, or the IOC ISOs, we covered that from the same creator of this post in a previous video. I'll link that down below or search for it on the channel. SLP, Supplemental Liquidity Providers. So what is an SLP? Market makers. For example, Citadel is an SLP. So SLPs are pretty simple to understand. They are market participants that use HFT to create high volume on exchanges in order to add liquidity to the markets. This is all done to create tight spreads. SLPs such as Citadel can artificially create liquidity in the market through explosively creating volume through the use of HFT methods. This is important. We have a reference to the Wolf of Wall Street here. Because GME liquidity has been drying up a bit since January 2021, Citadel and Co. need to use their position as an SLP to manipulate GME's price as us apes are hodling. The entire premise of market makers is to remain neutral and make money through scraping cents off of cents and off of the spread, therefore not directionally affecting the price. However, if they're on their last legs and they feel like doing something illegal, they can use a mixture of the order types above in combination with SLP to manipulate GME at their will. So we covered most of this before, but now that you understand that SLPs is just a role for Citadel to play that may or may not be completely neutral, now we are seeing how this can be an actual manipulation. SLP and our beloved TD-TOS errors. Let's clear up Thinkorswim situation once and for all, as they are highly certain this is exactly what they're seeing. As we've said before, Citadel and Co. can explosively create volume into the market. This is exactly what we're seeing flow through Thinkorswim. Myth 1, it isn't buy or sell. Well, it's neither a sell or a buy because it's both, which is why we see no buy orders or sell orders in TOS in the example below. It's also why we can't project prices using it. So any post you see trying to do that to justify the value of GME, it's just not true, as all of it needs to be executed. Apologies. So that's myth number 1. That's myth number 1 and then myth number 1 again. But this is myth number 2. It happens to other tickers. It's also commonplace within the market, which is why we see a pop-up for other stocks. In general, SLP is good because it does create those tighter spreads. It sure as hell can be used for manipulation if the SLP want to take illegal risks to shake retail investors from a certain stock, GME. So that is the idea, right? A tighter spread normally is good for the market. It allows you to get closer to the actual best price of the stock you can possibly trade it at. However, as we've noticed, there are players in the market, such as Robinhood, that actually benefit when the spread gets wider and you get worse spreads. So in that case, SLPs can be helpful to the entire situation here. Rewind. A very juicy pattern starts to emerge. We noticed that there were limit non-routable IOCs transferring their volume to these other 4 types of volume. When we see historical NYSE Chicago volume, we see visible step changes in the highs that sussly match up to the ALO's monthly increases. So we notice here that there is just breaking it down on time, the amount of increases here, historical view of the NYSE Chicago tape A volume. This also leads to believe why they're using ALOs as a buy-sell wall in level 2 data, which helps to control momentum. However, ALOs also need to be timed well, as they could be blown away due to pressure from other parties. So what are the tools that the hedge fund buddies have to manipulate the price? Number 1, IOC ISO orders. Cross-exchange sweep that allows them to get ahead of the order queue to an extent and then use as a buy-sell pressure when needed. Number 2, limit non-displayed orders. As a hidden order that does not affect the price, used to offset IOC ISO orders so the market maker can remain neutral without causing buy or sell pressure. Number 3, ALO orders, an order placed to create a buy-sell wall and then used to stop momentum and turn the trend around. So we have the entire arsenal mapped out right here of what they could do. So here is what the players, here are the players which they need to factor into their strategy. Retail investors like us, right, likely displaying a predictable buying pattern by now, so they can take us and our data into the consideration of how we can move, essentially playing 4D chess with our predictable movements. And this is even brought up in Congress, that we are unfortunately very, very predictable. So long whales here, Citadel & Co. likely know the strategy they are trying to employ out of sporadic buy pressure from the equity side of things. And number 3, other parties such as day traders, don't trade GME for the love of everything good in the world. You will likely just lose money straight up, and you're not helping the cause. Let's put it all together. Almost done, guys. They're taking 3 of the most recent observations of SOP volume from Thinkorswim and have marked them on a GME 1-hour candle chart. It's pretty telling looking at this straight away what's going on. At each of the specified candles that we've highlighted, we see a wall being hit and reversal in price. So this Redditor has created a wall here, which is a price that we had a thin green candle but get rejected and then trend downward. This break downward came from 180 all the way down to 150. We see another break here where we attempt to try and rally up to 140, then get rejected again. And then finally we see a break here at number 3 with 180 break, try and rise up to 220 and then break downward again. Strategy breakdown at 630 million at 181. Place ALO sell. So this is essentially how to be a supervillain, where we are taking a little bit of a switch our brains with Citadel and see what's going through theirs. Place ALL sell orders in to create a wall in preparation for earnings in aftermarket. Number 2, use HFT ISO sell order to create downward pressure during earnings call and after. Number 3, use HFT limit non-display buy order to remain neutral without creating any upward pressure. And this is repeated multiple times. 630 million at 181, 113 million at 120, and 290 million at 183. The question is, why are they doing this? Finally, we're actually getting down to the quick and dirty FTDs. Now that we understand exactly what kind of strategies that they are implementing, they all do this so that they can pocket shorts know that they have to cover a certain amount of failures delivers out of pocket each cycle. They naturally want the price as low as possible to do this. Cover implies whatever they could not borrow to use towards covering their FTDs. Yes, you read that right. The screenshots you see from iBorrow with borrowed shares disappearing is not part of the tax used to short the stock. They're being used to cover their FTDs. On that bombshell, back to HFT. As mentioned above, they'd want to manage buy pressure and keep the price as low as possible, so they sweep up some of the shares at the lowest price they can. This is what's happening with the first SLP volume coming through the picture above. Drop the price, then at the point where they can't drop it much further, they start sweeping up shares with ISOs and regular limit orders to cover the rest of their FTDs, which they could not do through borrowing. And this is the second SLP volume coming through. Lastly, they need to put a cap on this so that it does not get out of control, so they create a small sell wall and then start to work on the price back down again. A new earnings release was a good bet to tank the price. They had it all planned out from the PR campaign. Mainstream media was running to even profiting off the spread from the decline to the bounce to them adding liquidity to the market as an SLP. At theory time, the whole post is, but humor me, as I have a personal belief that fairly above is fairly on point. Do your own DD to confirm. We will see it again. History is likely going to repeat it one more because FTDs are cyclical. We see this behavior moving forward until the bubble bursts and the FTD cycle slowly grows out of their control. HODL. I base this on the fact that they believe that they noticed the SLP volume sooner. They would have matched this whole post to exactly what is happening in late February below. Theory number 2, option long whales. Shorts are trying to balance 2 plates. 1, covering these FTDs, the cyclical nature of FTDs, and 2, making money to cover these FTDs through options. They are carefully managing how they can use their HFT strategy using their status as an SLP to make money on options, as well as fund covering FTDs among other things like paying employees, etc. Essentially, when people ask, well, can they take a long position? Not really, but they can hurt the stock, buy in when it's low, cover their FTDs, and then hurt it again. That turns a small profit for them, small in the relative scale of things. This is where the long whales come in. Historically, in my eyes, whales are responsible for the spike in price on the 24th February to just under the $200 mark. Since then and much before, they contributed little volume. It's entirely made up of HFT and retail investors buying. Where they do play into this, and it's a valid theory, is using their weight when it matters to inflict max pain. So That took a lot of time, but mainly with this prediction, we can likely, with a reasonable degree accuracy, predict price movement. And we're likely going to start implementing this data itself into the live streams themselves. If you guys still haven't followed, let's focus up with some whiteboarding here. I'm actually going to turn my camera around so that you guys can actually read what I'm trying to write here. So the cyclical nature of these FTDs are as follows. Let's say that the banana price of GME currently is, what is it, 180? Let's say it was $200 before. At $200, they decide to borrow a bunch of imaginary shares. From the ether, they borrow a bunch of cells to drive the price down. Let's say that they borrow like 200 million 200 million is a lot. Let's just say that they borrow X million shares. Right? This X amount of shares is going to drop the price down to about $180. At $180, they implement their, using their power as an SLP, they implement the power of being able to borrow more shares from iBorrowDesk. iBorrowDesk is just an indication of where people are willing to give them more shares. Probably from you or me if you haven't turned off your Robinhood or Webull lending programs, or people who just want to be able to, you know, make, if their broker allows them, make a little bit of interest off of lending out their shares to hedge funds. Once more, try not to do it. But at $180, they can, out of pocket, buy a couple of these shares in order to cover the X amount of shares, and then borrow the rest. Locate borrowers from this imaginary, let's call this naked short cloud, and then be able to push it off again, because now they're not FTDs because you've located someone to borrow from. So now you're paying them the interest on a daily basis, millions of dollars a day. They are bleeding, but it helps them to make this $20 profit here. Because if they continue to hurt the price of the stock, we are going to see a resurgence when they cover, only because of the buying power that they need to do from their own pockets, but most of it is going to go straight back to covering these FTDs. So if this is the video that you have been waiting for to make sense of the whole situation, I would really appreciate a quick tap of that like button so that more Moon Platoon members could find out about this video. Thank you, every single one of them, Moon Platoon, Meatball Space Legend tier, and the Gorillionaire tiers for supporting the show, and I will see all of you in the money.